live from Chicago, and today is Wednesday. It is March 18th. It is 2026. Good morning, TheoTrade members. So the second part of today, we're going to pick up on the part three of a five-part series coaching session on stop loss orders. So I'll give you a recap when I get there, but I want to move forward because I have so much to say in so little time about the market as it stands right now. So good morning to the usual suspects. As I say, so much to say, so little time. I'm not disrespecting you. I see Bart, I see Tim, I see Anthony, I see all of you. The short trades are working out well today in the Genesis cog. Like I've said, you make more money doing nothing than doing something. If you wait things out, good things tend to happen, especially when you're positioned really well. Tony Rago calls it persistence beats resistance. I totally agree. If you can hold on, hang on tough. So let me get on upward and onward and get on with today's theme of the day. A lot of you are my age, so you got to kind of go back in time here. Let's jog your memory. Today's theme comes courtesy of the expression, but it's really a song. It's kind of both. There's an overlap. Running on empty. Now raise your hand. Come out of your closets, all of you. How many of you remember going back in time? The song Running on Empty. Come on, people. Bring it to me, people. I want to hear it. Let's go back in time to the 70s, to one of his phenomenal artist, Jackson Browne. I think Jackson Browne was dating Daryl Hannah at one point. Here's the album cover. I was lucky enough to pull it out, called Jackson Browne's Running on Empty. Everybody remember Running on Empty? Come on, people, raise your hand. Some of you got to be Scott B. Remember Byron? Great song, Running on Empty, because that describes this market perfectly. So let me bring to you the man himself when he was once upon a time. Young man. This is when he was in his early 20s. He's obviously an old man now. He's late 70s. Sadly, one of his sons died. When his son was 52 when he passed away. But this is one of the great rock and roll guitar players, singers, writers, artists of all time, Jackson Browne. So that's Jackson Browne's face. So once upon a time in my youth, Jackson Browne wrote a song. It was called Running on Empty. It was the fifth album by Jackson Browne. It featured theme songs around life on the road as a rock star, and the entire album was recorded on tour, either live or on stage, or in locations associated with touring, such as backstage, on tour buses, or actually in hotel rooms. So they never recorded the album in a studio, technically. It was recorded wherever they were at that given point in time. It was released in 1977, and the album reached number 3 on the Billboard pop charts in 1978 and stayed on the charts for 65 weeks. Wow, 65 weeks. The single for the title, Running on Empty, actually peaked at number 11, and the follow-up single, The Loadout/Stay, reached number 20 on the Billboard Pop Singles chart. The album received 2 Grammy nominations in 1979, one for Album of the Year and the other for Pop Male Vocal Performance for song Running on Empty, Once Upon a Time. If you don't know the lyrics of the song, let me bring it to you because I have the lyrics up on here. I don't want to go through all the lyrics, but the reason why I bring it up is simply a lot of you are I'm not getting through to a lot of you. I'm not really much of a day trader, so if you are, you can ignore what I'm saying. But I keep telling you, this is the type of market where you think you have a handle on it, and it does crap that just flips you upside down and goes, you don't understand what's happening here. Okay. Algos are making things messy. Money managers are buying 10 stocks and selling everything else. We're hanging on by a string. The fundamentals are terrible. The technicals are terrible. There's no tailwinds. Okay. And so Jackson Browne, the lyrics capture exactly what I'm saying. Let me explain to you why Jackson Browne wrote this song. What is the epicenter of why he wrote this song? It reflects the exhaustion, this market, the restlessness, this market, and the relentless pursuit of purpose in life, using the metaphor of life on the road to explore both personal and universal struggles. So Jackson Browne said in an interview that he wrote Running on Empty while experiencing the literal and figurative fatigue of life on the road as a musician. The phrase originally referred to the driving with little gas, this market, because there's just no energy, there's no liquidity, while commuting to his album to record his album called The Pretender. But Browne expanded into a metaphor for emotional and physical depletion when he wrote the song. The song references specific years from his youth, from 1965 and 1969, mirroring his own experiences of ambition, freedom, and self-discovery. So all I'm going to bring up is the refrain of the first lyrics. The song opens up, looking out at the road rushing under my wheels, looking back at the years gone by like so many summer fields. In 65, I was 17 and running up one-on-one. I don't know where I'm running now. I'm just running on empty, running on empty, running blind, running on, running into the sun, but I'm running behind. People, this is what I'm trying to get to you, which is stop buying the market and let it correct 10%, because all you're doing is slowing the inevitable. This market is simply running on empty. I can't say it any better than capturing the lyrics of Jackson Browne's song. We're running on empty. The market's exhausted, people. It's tired. It's been going up for literally 3 straight years, every single day, every friggin' day for 3 years. Forget about the last year's 1 week hiccup of Liberation Day. That's garbage. It's dilly squat. We've been going up for 3 years, literally since 2022, for almost 3.5, 4 years, pumping liquidity, valuations out of control, chasing narratives, chasing themes. We're running behind, people. You're running on empty. The market may bottom. It may bottom at 6,600 and get a tradable bottom. I wouldn't buy this with your money. 10% is the minimum. So when we rallied yesterday, I told you, I said yesterday, just sell into the rally. I don't even think. It rallies, I sell. It rallies, I sell. That's what I do. When it rallies, I sell my highs. I just get out. They're not going to go much higher. Neither is this market. How much lower is it going to go? I don't know, but the downside sure outweighs the upside. So today's theme comes courtesy of the song Running on Empty by Jackson Browne. And what even more fortifies my thesis here, and it's not about being biased, it's just about common sense. Okay, I've been around too long to think that 3% is a correction. That's not a correction. Not even 10% is a correction. 15 to 20% is a correction. Now we're talking. So the first catalyst I call Moody Blues. Once again, my song background thematic type of angle. Moody Blues. Remember the Moody Blues? I actually saw them in concert in 1980. What did I say? I saw them in 82 in concert at the Circle Theater. I saw them in the South San Francisco. And who opened for the Moody Blues was The Fix. Remember The Fix with Reach the Beach and Saved by Zero? They opened for the Moody Blues. Anyways, the reason why I call it Moody Blues has nothing to do with Moody Blues. It has everything to do with Moody's. What's Moody's? Moody's is a bond rating agency. So if you ever saw the movie The Big Short, you'll see that there are four big bond rating agencies: Moody's, S&P, Fitch, and Duff and Phelps. But the real icon of the bond rating agency, supposedly supposed to be independent, but they weren't at the time, was Moody's. So I call it Moody Blues. Why? Moody's came out with a piece yesterday. I'm just the messenger, okay? So don't shoot me. I'm not a perma bear. I'm just bearish for the moment, okay? They said in their white paper, a recession is going to be hard to avoid if oil prices stay elevated for another month. So let's put this in perspective. We've been at war now for approximately we're almost running on 3 weeks. Let's call it 17 days. What they're saying is if we keep prices of oil elevated at this level, and they didn't specify and say 100 a barrel or 80, it's just at an elevated level. If you continually stay up here, it's automatically going to push us into a recession. It's completely unavoidable. Now, I'm not an economist. I do lean on people. I call people up. I ask around. I say, what do you think? I just went back and looked in time. I do what Gianni does. I do my own due diligence. It turns out when oil is above 85 to 90 a barrel, every single time in every instance, the economy went into a recession. So Moody's is basically leaning on historical events, past history. So if you're going to tell me it's different this time, you've lost me. I can't listen to you. Stop. It's 100 out of 100 instances. So if it's a sample set, it's 100% done. If we continually have oil stay at these levels, okay, you're buying into oblivion. A lot of you are going to lose. Your accounts are going to blow out eventually. Now, if you want to buy oil stocks, I'm not going to fight you on this, okay? I won't. but everything else is at risk here. Unless you get the PE ratios on these stocks into single digits, you're basically barking up the wrong tree. Everything I own, every stock I own has a PE level of 11 or under. So I can't lose that much money. This market going to have 500. My stocks won't fall that much. They're floor valuations. The problem with the market is the market's not at floor valuations. So remember what I said. Moody's is giving you the warning. They're giving you 3 weeks to a month. I wouldn't even give it 2 weeks. I think we're already pushing into some type of recession. And if it ain't a recession, it's stagflation. But if you're buying this dip and you work for me, I'd simply fire you, because the downside is far out. The downside is 600-700 points. The upside's 100 points. It's an easy decision, people. To make 100 to lose 700 is just stupid buying. That's the way I look at it. Next on this, okay? Economic Darwinism. So people like, well, what's economic Darwinism? Okay. Economic Darwinism is, and I put MS up here. MS is the acronym for Morgan Stanley. So once again, I am just like a parrot. I'm pulling out a Morgan Stanley report that I read, and Morgan Stanley said, quote, and they're way smarter than me when it comes to private credit. What do I know about private credit? That's not my thing. I'm a stock guy. I'm a stock trader. I'm a portfolio manager. This is not my bailiwick, but I have to lean on other people. Morgan Stanley tends to be a perma-bullish firm, but every now and then they come to their senses and they're objective. Goldman Sachs is always objective. That's why I listen to, I think Goldman's the premier. They're always objective, right? Raymond James, can't listen to him. Can't listen to 90% of brokers. They're always bullish. Always. They're always looking for reason. Tom Lee is 100% bullish. If he ever gets bearish, I'm going to have a heart attack and keel over. You have to call an ambulance. These people have no credibility. You have to be able to look at both sides of the argument. So Morgan Stanley says a private credit shakeout is in the offing. It's on par with COVID losses in the offing. Now, who am I to say that Morgan Stanley's wrong? I'm not saying they're wrong. I'm just saying, is it on par with COVID? I don't know. That's what they're saying. They're saying there's going to be a shakeout in the private credit markets that's going to leave a lot of scorched earth, and it's going to breach every single financial institution in the world. It's going to reach brokers, asset managers, banks, lenders. It doesn't make a difference. It's going to be spread out. It's like a cancer. It's like having rabies in a dog. It just goes everywhere. They're saying it's going to be COVID-like. Now, I call this like a little bit too much. It's like a little bit Chicken Little, like it's the end of the world. But that statement alone, even if you agree with it or not, is telling you that Morgan Stanley sees all kinds of landmines everywhere. If that's the case, then why are you buying the market? Defend yourself. Send me an email. Why are you buying this? If you know there's going to be some shakeout, whether it's horrific or whether it's mild, it doesn't make me want to buy. I buy when everything is like when it's settled, when it's scorched earth. Then I'll buy, because I want to get all the risk away. I want to get all the overhead supply away, and I'm ready to buy. We're not even close to a bottom, people. We may be near a tradable bottom. Oh, we'll bounce off of 6,600. You really want to buy at an all-time high when the market was at 2,000 just a few years ago? Not me. So again, I call it economic Darwinism. Some of the firms will shake out and survive. Others will go under. Obviously, Blue Owl's under pressure. The last one, once again, comes courtesy of what I call my, my background and love affair with music. And I think Brandon Chapman falls into that same category. I think Brandon's a little bit sharper than me. But I call it like Trivial Pursuit Jeopardy when it comes to music. Like, music's my thing. My sister and my best friend, he's got 48,000 songs on his iPod. 48,000. He knows a lot, way more than me. Me, it's just a few thousand. But this one I call Shock the Monkey. Now, Shock the Monkey is a reference to a Peter Gabriel song. It's one of the phenomenal songs of its time. But I call it Shock the Monkey for this reason, okay? Central banks are now coming out every single day because they have to. They're in the limelight. They're front and center. We got the Fed doing their decision today. They're not going to cut rates, so let's not sit around here. But hear me out on this, okay? The central banks are facing a policy trap right now. Why? Because the Iran war is driving inflation. It is driving inflation, but it's not the only thing driving inflation. It's driving oil inflation, okay? It's driving logistics inflation because it takes long, and supply demand disruption deflation. That goes without saying. But at the same time, you're getting inflation. remove the inflation equation. The entire economy is just fading. We're going into a fading economy. Remove the data centers. Take away the data centers. Remove storage technology and Micron. Get those out of the picture. Remove them. There's nothing driving the economy. Nothing. Nothing. Zero. No rate cuts. No growth. All these companies, look at the charts on the retail. They look like the economy's fading. Fading. Why are you buying? If you're going to buy, you buy when it's bottomed. If it starts to fade and you're buying as it's fading, that's how you blow your account. You buy on the way up, not on the way down. Growth is fading. Inflation's going up. We're going in the wrong directions in both. So the point being is every central bank, not just the US, but Christine Lagarde, Japan, whatever, all the banks are sitting there and their hands are completely tied. They can't cut rates. Why? Because inflation, you just had another inflation report just come out. Inflation's now reaccelerating, as I told you it would. And then, of course, Blake is the only one behind me. Blake calls for stagflation. Yeah, why not? We haven't had it in a while. Looks like we're going in that direction. How long will it last? Don't know. How am I supposed to know? Nobody knows. But if you're heading into the fire, okay, why wouldn't you take precautions? It's not that you have to sell the market and get out completely. Hedge it. I am so hedged. I am choking hedged. I'm short Coke. I'm short Sysco, the food. I'm trying to get short a little Starbucks. I'm getting more and more short every day. I told you this. I'm lifting the shorts and lowering the longs. You turn me into a bull market, I'll take off the shorts and load back up long. It's like a scale. People, it shocked the monkey because the market's going into a shock formation. It's a lose-lose situation. So if you're telling me you're buying here, all I'm gonna say is this: if any of you worked for me and bought here, I would just fire you. You're fired. I don't care if I own the firm. You're fired. You don't buy here. You don't buy this product, the S&P. What you do is you scale out of S&P highs. You add to S&P low defensive, low valuation, would have upside, and you continually short the S&P futures. So you just wear down. You ward off all of that pain. So yesterday, the market, I had a really good day. Today, my account's totally flat. I'll take flat. I'm flat. I will take flat because I'm dealt along 500 in this account while the market's down 52. That's because my short trades outstrip the long trades by deltas. That's what I'm telling you. The market is running on empty, and you have absolutely no reason to buy with any of these headlines. I don't even care what the Fed says. I'm not even listening. I don't care. I know what I'm seeing. I see the data. Now, as far as individual stories, there are stories where there are bottoms to be made. Multi-decade bottoms are to be made. There are buys out there, people. I find them every day. Every day I find buys. Every day. Here's one right here. I call this sign of the times. This stock has been absolutely beaten to death. Beaten to death. But the company came out today. They earned $1.01. Clearly, the market was dead wrong. Their market was not even close. Your analysts and all these people who sold it and panicked, they sold it because it was window dressing. We're in the last 2 weeks of the quarter, so all the window dressing numbnuts are going to sell everything. That's why none of the 52-week lows are going to go up. You have no chance of making money. You have to wait until April 1st. That's why the market's being dragged down. Bad quarter, bad advanced decline, bad breath. Why? That's another reason why the market's going down, absent of fundamentals and liquidity. No liquidity, no fundamentals, and now you're at the end of the quarter. That's why the market weakens. This stock, I'm holding off to buy. Why? Because I want to see the shakeout. Apparently, AI has this disturbance in the force has messed up their business completely. This is a tokenization, DocuSign, legal where they send it to you. But there's all kinds of other competitors in here, okay? So when I say sign of the times, I'm not willing to go out and buy just anything because it's down. Even if the valuation is compelling, that doesn't make me want to buy it. I have to buy it because looking over the horizon, 3 years out from now, this company doesn't have a lot of competition in front of it. That's the important thing. So if Coke blew out or Budweiser crashed, I'd buy them. How much competition is there for Budweiser? Not much. Problem with DocuSign is it's a sign of the times. Get the pun? They're up against some heavy competition. So they earned $1.01. It came up from 86 cents. It wasn't the end of the world. I'm tinkering with why I should buy them. It's not 33, their multiple. Their multiple at this point is 12. The question is a 12 multiple low enough to buy this, or might it go lower? I'm not sure just yet, but I'm going to monitor this. You can't short it because you can't commit suicide jumping out of a basement window. The stock's already crashed, so what's the point of selling, right? But to buy this, I'm going to watch it carefully and we'll see. But just because the stock has been crashed doesn't mean it's a buy, and this stock has crashed. 314 to 48, people. Oh, stocks are never going to come down. That Nvidia is never coming down. Yeah, talk to me in 5 years. They all come down, people. They get them all. Question is, are you going to get out in time? Next here, lemon drop. Lemon drop. All right. So I had to scale out of this yesterday at 164.5 because I had to sell it because I'm not going to hold in front of earnings. But we look like we're starting to get to a bottom on this. I'm actually revisiting buying this. This is a turnaround story. Now you look at Lululemon and you recognize the stock has crashed. Don't say it's corrected. Stop with the lies. It's crashed. 516 to 164 is simply a crash. It's down literally 75%. So now what? Do I buy it? Maybe. Now I tried to buy it at 174, sold half at 190, came back down, sold it yesterday early in the morning. So I basically broke even on the thing. Didn't really come out ahead, that much ahead, maybe a few bucks, but I don't hold through earnings. They dropped it down this morning early to 156.64. That is basically a multi-year low on this. Would I go in and buy this? Yes, I would. Actually would go back in and buy it. But I need to see a little bit of technical repair on this, technical repair. And the thing was, this had a $15 expected move. Why did I get out of the trade? Why did I actually get out of the trade? Why? Because I'm not going to sit there and try to price a hedge on a $15 move. It's worthless because at this point, it's already crashed. But that doesn't mean it couldn't crash $15. That was the expected move. I just didn't want to sit there and go, well, you know what? I'm sitting here long a stock at 165 and it drops to 150. The Genesis Cog people would go ape on me. So I instead advised them, either buy a put, sacrifice a buck or two, or just get out of it. And you can always buy it back. I'm actually looking at it technically, looking to buy it back because I think it's a total washout and it's a turnaround story. So this is different. Why is this stock different than DocuSign? Because DocuSign's got tons of competitors and Lululemon is like a category unto itself for yoga. It's different, okay? It's a different animal, a different business model. So I'm looking at buying Lulu. I think it's actually a buy here. I might go back in and buy it, just throw in 50 shares to buy it. But while this market's going down, Lulu could actually gain traction because it's already crashed. I buy stocks that crash because the downside is mitigated. I just thought, well, if it goes to 150, I don't want to take that risk, but I'm still willing to step in and buy. I can sell stocks and buy them back higher. I'm just not willing to buy. I want to wait for a few more days, but I like what I see on the accumulation distribution. A lot of short covering here. The next on this list is this, okay, from the current slide. Power off, like, you know, Power Ranger. Okay, let's look at Oklo. Simple rule of thumb. People, I have a simple rule of thumb, okay? I never buy on the way down and I never short on the way up. That's how I avoid catastrophic losses. I just don't do it. So let me lay this on you. Here's Oklo, okay? Flat. Flat. Okay, look at the earnings. All I care, look at the earnings. Okay, so they lost a lot more than the estimate, and the stock didn't move. Does that make it a buy? Why is the stock not going lower? Apparently, Wall Street's telling you that the earnings don't matter, that they're looking forward and saying, well, you know, Oklo is in the quantum computing business. They're in the energy business. Look what they do. They're basically like an oligopoly in what they do. Go check out what they do. Fission power plants to provide clean, reliable, affordable energy at scale. How many do that? Not that many. So they're in a sweet spot going forward, which meets the EPA standards. They could be bought out. They've got an edge on their technology. That's why it doesn't go down. So when you look at the difference between this and DocuSign, both of them have crashed. Why does this one not go down when the earnings suck and DocuSign not get much? Because people are looking ahead going, Claude, ChatGPT, OpenAI, and they're starting to see like, well, where will this company fit in the long term among all these different applications coming out? That's the problem. This is a different animal than DocuSign, which is why it's looking at a floor value. Would I buy it? No, because I don't buy companies that don't make money. I just don't. But if I were looking at this right now and saying, would I short it? You can't short it either because it's in a hole. You can't short it. You can't buy it. It might just trade flat here for a while until this company can start to prove that they can actually monetize. Then it will probably come out of its death spiral. Now, the last thing I want to throw out is this. Okay, last one. I call this holiday parade. Now, just me personally, I won't buy it. And I know it's a good day. You don't have to tell me. I call it the Macy's parade, like Macy's parade. It's up 67 cents today. It's what they call a gravestone doji. Is that bearish? No. Is it bullish? No. Would I buy it? No. But it fits the Genesis Cog footprint. I know it does, but I'm not buying it. Look at their earnings. Their earnings are actually pretty good. Look, they're not bad. Why won't I buy it? Couple of reasons. Number one is maybe they're a buyout candidate. That's why you buy them. Maybe Macy's is in play. Elliott comes out. One of these activist groups comes out and go, we'll make a bid. We'll buy a proportion. We'll jack it higher to 22 and unload. That could happen. So you can't short it because it's in a hole. That you can't do. The company does have assets you could liquidate. My problem with Macy's is looking forward. Here's what I see. Amazon, TJ Maxx, Ross stores, end of discussion. Why do I need to go to Macy's to get the same things I can get at those places at half the price? This is a premium omnichannel retailer is really what it is. And they do have an online presence. The problem I have with Macy's is that they are a buggy whip with around a horse in a Waymo world. We have driverless cars. This is an old business model that hasn't caught up yet. It's just not there yet. And it's not discounted. That's the problem. So even with the good earnings, I still wouldn't buy it. And you can see with that money flow, institutions are selling into this. The second reason why I wouldn't buy it is simple. If the economy is getting weaker and people are getting laid off, what reason? Like I can understand like some of you going, well, I'm going to go buy Ross stores. Yeah, because it's discount. I'm going to go buy Marshalls, TJ Maxx. Yeah, discount. I'm going to go buy Walmart. Yeah, discount. I get it. Where are you going to, this does not go hand in hand with a weak economy. When the economy is compressing, this is the last stock I want to own. I don't want to own this. I don't want to own Polaris snowmobiles. I don't want to own discretionary retail things in a crap economy. And the economy is not getting better. It's not falling off a planet, but it ain't getting any better. So for me, I can't buy it because of the rotation, the seasonality, the place the economic locate where we are economic seasonally. And I can't buy because money keeps coming out. And no matter how cheap that valuation gets, I don't see how this is going to compete longer terms with new disruptors in the retail space. So for me, I applaud them. It's a Macy's parade for a day, but that doesn't mean I want to buy. None of these, the only one that scratches my itch to buy is actually Lululemon. That's it. None of the others do. None of the others do. Okay, especially Oklo, because I'm not buying I'm not going to buy something where they don't make any money. You can forget that. It's nothing from nothing leaves nothing. So I just consider it like a Billy Preston song. All right, let's move upward and onward, and let's get to the third component of the third part series of stop loss modes. Stop loss modes. Oh, look, the market's starting to come back. Should I get bullish? Oh, just want to look at some of my positions. The shorts are absolutely killing it today. I can't explain this anymore. Look, it's a real good day on the short side. Good day on the short side for Coke, SYY, we're short that. It's okay. All right, so I'm going to pull out a stock today, and I'm going to leave it at Pepsi. I don't have a position in Pepsi, but Pepsi's on its way down. I think it's going to find itself to 133, at which point I'll probably be interested in buying it. It's down already from 170. That's what happens when you buy at highs, people. You buy at highs, good for you. I don't buy at highs ever. Doesn't mean I short it. I just don't buy at highs. I buy them when they crash, so I mitigate all the risk, or at least they come down a certain distance. Today, we're going to do stops by integer and stops by percentage loss. I will address the stock portion of it and contracts portion, futures, cash market, and I will address the options as well. Yesterday, I did stops by channel violation. We talked about horizontal channels, ascending channels, and descending channels. As I said over and over, you don't need to be a rocket scientist. You don't have to be a genius. You don't need to go to school for 4 years. You don't need to go to a trading academy to understand. Just go in, step in, draw the higher highs, the lower lows, draw ascending and descending and sideways channels, and you're good to go. You can literally put on stops, see an extraordinary candle, and bail. Today, we're going to talk about stops by integers. What does stop by integer means? It simply means stop by price or by price movement. So there's different ways you can go about this, okay? And this isn't necessarily about drawing support resistance, okay? This is just about you looking at a certain situation where it doesn't fit your comfort zone, where you go long a position and you're saying, well, where do I place a stop? And my answer is, well, you could do it by ascending channel or descending channel. And you could say, well, you know, I'm not much of a channel drawer. Okay. You could defer to what? You could defer just to a number. You could say, okay, I'm going to set a certain price level that keys off a certain drop or magnitude move in the underlying. So for instance, if I stepped in here and I said, okay, I'm going to go in and I'm looking here and I'm going to buy Pepsi right here. It's a breakout, it's earnings, and I'm buying on the breakout. Now, I got nothing against buying breakouts. In fact, buying on breakouts is a good thing. I'm just not much of a momentum trader, but I would rather buy the breakout than short the breakout. That's for sure. Here's Pepsi having a monster day after reporting 226 and the stock doing a Maribozu, and then there's a gap the next day. So let's just say even during this day, you stepped in and said, all right, I'm going to step in right here and I'm going to buy at around 162. I'll just give it 162 even. So I'll lay it right there at 162. Okay. Remove it. I'll even walk in here and use the text note to like draw this out and remove that one. So your purchase price is 162. That's where you entered the trade and you're happy with it. So I'll take this off, remove the arrow number 2. Pardon me. Remove, where is that? Remove drawing, and then bring you over here. So you decide to walk in and say, I'm going to buy here on the breakout. How could you place a stop as a stock trader? How could you do it? Okay. What you could simply do is you could look back at previous channel movements. You could look back at previous channel movements. This isn't necessarily about a support level, although you could use it because it's right there horizontally. It's just looking at the stock and looking at channel movements of where they've made moves before their consolidation blocks. So here would be considered like a bottom, even though it overshot here. I'm not going to not going to do what I call split hairs. It's through, but it's pretty close to that 137 level. And then you can see here, it pulls up here and it starts here. So if you actually just calibrate the underlying of Pepsi, and this goes for any stock, oftentimes what technicians simply do is we look at channels, and we look at channels not necessarily as support resistance, but as magnitude of move or stop loss, what we call by integer. So for here, the move from here to here before it backed off, 148 to about 139, that's a $9 move, $9. Here, this move here is from 148 up to 155. That's a $7 move. So one's a $9, one's a $7. Add them together, and what do you get? You get $8. So on average, every time Pepsi makes a run, like a flag formation, an escalator, up, flat, it's 8, flat, 8, okay, pull in, 8, 8. It's making like quantum leaps of $8 per se. You could literally sit back and say to yourself, okay, I'm going to place a stop based upon the magnitude of move of what is $8. So from the move from here, 155 up to 162, that's $7. You could just place a stop right down there and say, if it falls $7, I'm willing to part from Pepsi. That's a way of doing it. You could literally just step up and pick up numbers and say, at this point, I can't stand anymore. I'm going to get out. Now, if you were to step in to do a trade on a futures contract, you'd have to think a little bit differently. And the reason being is because even if you check through here, okay, $8 on 100 shares is $800. So you know how much you're going to lose on that $8. This is a little trickier monkey because every 1 point move in the S&P 500 equates to what? It equates to what? Equates to about 50 cents, right? $50. So a 2 point move is $100. So if you said to me, well, I'm willing to accept a 10 point, drop in this product, that means you'd be telling me that 10 points equates to $50. 10 times 50 is 500. you're willing to lose $500 before you pull the trigger and eat it. That's what that would mean. So if you played the game here where you told me, well, there's breakouts and there's ranges, and you talked about ranges, and here we are in a range, and right now, because this is what it looks like. This is what the ranges look like. The ranges themselves are 71.37 to 70.19. That would be a 100-point range. A 100-point range. For you to set a stop on this means on one contract, you lost 5,000. Can you really tolerate a $5,000 move? Really? I doubt it. So when you're trading certain products and you go by integer, you have to calibrate the integer to the actual delta or the dollar amount of money you're going to lose, or you're going to get completely wiped out at one point. I would never let a 100-point move on this one. Intraday position trade for this, I'd have a heart attack. I'm not giving up $5,000 on a $100,000 account. That's $95,000. Are you kidding me? A 5% loss? That's like a catastrophic loss. So this is not acceptable, like to play that much in a contract. So if you're doing the product like this, you'd have to put a much closer tight, constraint on it. So for me, like the most I would ever give up is 10 points. That would be it for me before I stopped out if I traded this product, because I can't eat more than a $500 loss on $1,000, because at some point you're going to be a deer in the headlights and never trade out. You're going to walk it down. So now it's going to go from, hey, I'm down 100 points to 500. Now you're down 500, which means you're down 25,000. So your account at 100,000 is at 75,000. And you're stuck. Don't worry, it'll bounce. I'm not worried about the bounce. I'm worried about you getting margined out by Tasty Trade. They're just going to shut your account down. You've already blown through the margin. Don't worry about me. Worry about you. So you got to figure out at some point, what is your pain threshold for downside moves and upside moves because you never know what could happen for things to actually run away against you. Let me show you something here. Like Gianni was throwing this out the other day on Circle, and this is a wild, wild, wild child. So if you were asking me, like, how would I set a stop if I were to short this stock, just on the short side? If you said to me, well, I'm just going to short it based upon a channel, that could really hurt you. So the channel itself works as long as the stock is low beta. If the stock is not low beta, the actual channel or the channel movement trick I showed you as a technician could actually turn against you and blow you out. You have to sit there and recognize, like, what would be the risk? So this is what I would advise. One of two things. Go to the ATR and look at the ATR and say, okay, how much pain can I absorb in a given day? So you have to recognize, like, this thing is moving $8 a day, $8. So if you came into me and said, well, I'm going to short right up here at 103, and you're like, it's already up from 50 to 103. It's up 100%. I would go here and look at this and go, listen, this thing could move $7 in a day. Are you willing to stop out on a $7 a day move to get short? Because if you're not, you shouldn't trade this, because $7 is the normal daily move for this, $7. And now it's $8. Like $8 against this in an APTR, a percentage, that's like a 4% move. If you can't handle it, don't do it. So setting yourself a stop by integer is tricky. It's a different mode than doing it off a channel completely. But at some point, you have to cut and run. You literally have to cut and run. I was faced with that at one point when I shorted Roblox, and I was like, damn, I'm down $9. I cut and run and ate it. I was done. It was like an 8% loss. I couldn't take any more. And that was me being in, okay, quote unquote, not a stock, but that was an option trade. It was an option trade by the dollar amount I looked at it, but I was still looking at the option percentage too. In either case, it was a horrible loss. So at some point, you could just establish a dollar amount, and you could do it as like an ATR, or if you don't want to do it as an ATR, hell, do it an expected move. Over the next 9 days, this is expected to either go up 14 or drop 14. It's not a directionally biased indicator or metric. It's just saying, okay, expect this stock to move twice the ATR is what it's telling you. So you might just be stopped out, period, long or short at that time. So if you can't handle something like this to be stopped out, my advice is you should not probably be in that trade, because it's likely going to trigger for you or against you at some point. You have to realize that when you're dealing with stocks of this nature. So for me, when I set stop losses on certain stocks, if I think the stock can go beyond a number I can handle, I bail. Like I walked in, I told you, And I was like, hey, Lulu's going to report. I don't want to hold through this report. So I blew out at 164.5. I just blew out. I didn't want to set a stop and go, oh, I'm going to have a stop. I can't take a $15 hit. No way. If you can't take the heat, get out of the kitchen. Okay. It's really important you understand that. That's why most of the time when I trade stocks that are incredibly boring. They're sleepy. They don't move that much. They're off the radar of most traders because I don't want heavy liquidity. They're going moving it around and getting my stops triggered. So I'm in one day and out the next. Don't want that. I want stuff that grinds slowly. So if it grinds slowly, I don't get anxiety. I don't get all worked up, and I'm not likely to get triggered on that stop. But a dollar amount is something you have to establish. For me, I don't look at Lulu as a dollar amount trigger. I look at it as a percentage amount trigger because it's $150 plus stock. Now, for me, like I have a really small position right now. It's a really tiny position, and the position is in Etsy. It's not that big. It's a few hundred shares, but Etsy's $55. I look at the range of Etsy. I'm aware of what the beta is. The beta is 1.6, so it can move. I'm aware of what the ATR, it's 2.6. So I set my stop comfortably, down to a certain level, at 48 level, where I'm willing to bail on that, because if it goes through that, it could fall much further, much faster. But this happens to be one of my long trades that's okay on the long side. But yes, I have a stop in place. I know exactly where it is. Okay, I know where it is, but it's not for everybody. So be aware of the integer. Now, the flip side of this is, and what most traders do, is it's not the integer. That's not what most traders do from my experience and the people that I know in the business. Most traders, if they choose to identify a number, a figure, if they shun the channel and they shun the gravity point, support, resistance, okay, they will defer. And these are people who are traders, not investors, but traders, because they can't sit there and let positions bleed away, eating up margin, okay, and then lose buying power. So they will do it by percentage loss. That is the way I advise most of you to do it. I'm not advising against the integer. I'm just saying a percentage loss puts things in much easier perspective. So for instance, you tell me I have a position and I'm trading something like McDonald's, which is getting battered today. All these stocks are getting battered. It's not just McDonald's. It's McDonald's. It's not McDonald's. They're all getting killed today. Every one of the defensive stocks, even the ones that I own, are getting whacked. Why? Because it's a rotation. It's an economic rotation, so they're whacking all of them. So McDonald's is down today about 5 points, 1.63. Okay. If you looked at it on a dollar for dollar basis, I think it's difficult. I think putting it in perspective on a percentage is a lot more, like I said, amenable. At 341, let's just say you walked in and say, I bought it at 324. Okay. Can you handle a 10% loss? Do the math. How much is a 10% loss on a $324.25 stock? It's 32.5 points. Can you handle a 32.5 point drop? If you can't, then you got to raise the number on the percentage. For me, I will on certain stocks have 10% losses. A 20% is unthinkable. A 10%, yes, depending upon the beta on the stock. But a stock that's above $100, you really have to put a tighter leash on it. You have to literally say okay, I might put that at 5%. You have to put it, contextualize it. So you take the price of where you actually entered it, and you just sit there and you take a percentage and say, okay, take out a calculator and say, well, what's 5% of 325? Well, 10% of 325 is 32.5 bucks. Cut that in half, it's 16.25. So all you can basically handle is 16.25. So if you came in here, put a little arrow to remind yourself, this is where I bought it, 325, okay? And 16.5 off of this drives this down to about what? $309, $308, okay, right about there. There's your buy, there's your stop. Just go out. This is what I would do. Just step in with a text note and just say, purchase price, identify your purchase price right up over here. And over here, you'd say stop price. Just leave it on your chart. And you'd say stop price by percentage, okay? The one thing we cannot do day by day is we cannot necessarily predict what is going to happen. Instead, what we do is we have to defer to whatever tools we have. And people say, well, give me some of the tools. I told you some of the tools. One is an ATR. The average price on this is $5 per move per day. $5. So if you realize that if you were to put a $5 stop against that, which is a 1 ATR, that means within a day, the $5 would get you down pretty much like, that would be about 1.65%. That would be way too tight of a stop. I think a 1.65% stop is too tight. Most traders, and this is just from books that I've read, will put a stop between 8 and 10%. I think that's a good spot. Can you bend those rules? Yes, but you can only bend those rules depending upon the wonkiness or the volatility characteristic of the underlying. Because at times your stop will be taken out, it'll go through and come back through. I am absolutely certain this morning, a lot of traders stepped in, got triggered on Lulu, and now that it rallied back $8, they're ruining that trigger. I'm sure they are. So you have to be aware of what you're trading. If you're trading AT&T, it's not likely you're going to get triggered very often. If you're trading Verizon, not often. If you're trading something like Circle, if you're trading Oklo, if you're trading low blocks, you're likely going to get triggered a lot. So you have to make a different approach to the high volatile stocks on a stop loss than the quote unquote the low volatile ones or the low beta ones as they would describe it. It's something you have to recognize. Now, here is something that I do. And it's just me, but not everybody. When I look at certain trades for a stop loss, not a gain. I took a gain today on Bank of Hawaii. I bailed. I covered for 1 penny my option. I actually covered for a penny on my 80.85, but that was a gain. But let's just say you turn this around and it were a stop loss, and you were to do an option or a spread. I'm just going to leverage off of what I've learned from Tom Sosnoff and Don Kaufman and Brandon and Blake. I'm just going to leverage off what they do. Number one is you never put a market order in for a spread. There's no point. There's no need. You'll absolutely get carved to death and ripped off. Whatever money you're going to lose even more. You're going to add insult to injury by getting filled at the low of the day or the high of the day by covering. Either or, you're going to pay the worst price of that day. You're going to be carped by an extra 15, 20 bucks off of just a spread. You will. So when you're working an option order, even if it's a stop, you're taking a loss, work the option. Even if it's a spread trade, even if it's not a spread, work the trade. Never do an option market order ever. Just work the order. But let's say you were in a spread trade. My rule of thumb is simply this. How would I get out of a spread trade that is not working? Let me give you an example of a trade, okay, that I sat on. I'm short this stock. So are the Genesis Cog members, okay? I shorted here. I got out here. Why? Because I didn't want to pay that. I did not want to pay that dividend. That dividend would have been assigned to me. So I covered and I said, if the stock bounces back up to 78, I'm putting it back on. So what did I do? I put the trade back on Monday, just like I did. I put it right back on at 78. I'm working a 78.81 and I'm working a 79.82, both. Now, here's the thing. Let's say the trade's not working for me. It's working against me. And I'm like, dang it. How would I approach this? Well, first off, to me, you have to toss aside the dollar amount. Why? Because I'm not in the stock. I'm short the spread. And the spread and the stock are two different animals, or two different products. So what I often do is I say, okay, if I start losing on a trade, I have two options. I can roll the trade, or I can eat it. Half the time I roll the trade. Half the time I eat the trade. That's just my normal kind of trading behavioral, pattern. But if I didn't want to roll the trade and I was like going to eat it because I'm running out of time, I try to set a worst case scenario. And my worst case scenario is, for example, in Coca-Cola, $3 wide spread, right? I sold it for about $1.30. So my risk is I lose 170. Take the width of the spread, $3, sell my, subtract the premium. So I collected $130 premium. My risk is I could lose 170. My attitude is simply this. If I think I could lose more than 55% of that option spread, there's a likelihood I'll either close it out or roll it. Most of the time I close it out. I'll just close it out. I closed out losers. I did. I closed out one loser on Monster, I rolled one Monster. The one Monster I rolled, I made a killing. The one Monster I took a loss on, okay, it was just simply, I was down about 55% on the option. I knew it wasn't going to come down. I wasn't even going to break even. You have to sometimes, in your career, you just got to do it. I call it a Kaufman. Just admit you made a mistake. It was a bad trade. It was a bad trade. So what do? For me, I'm more about salvaging the premium and getting something back than riding it to hell. Now, some of you are like, I'm just going to take this trade and ride it to expiry. I won't. I will not do that. If I make a bad trade and I sell that premium for $1.30, the next thing I know, that premium is $2.10 or $2. I'm done. I'm done. I'm going to cover it at $2. I'm going to take a 70-cent loss, which is $70. I'm going to buy it back at $2. And you're like, but why? Because I'm going to salvage 100. Instead of me maxing out the loss, I'm going to max out the loss. You have to look at it this way, people. It's just simple math. I'd rather get something than nothing. That's just who I am. So for me, you got the $3 wide spread, $3 wide, right? I got the $1.30 credit. That's my potential gain. Plus, I've got the $1.70 risk. If I cover for $2 on this one, I end up losing minus 0.70 or $70. But how much is salvaged left over? $1 salvage value. That's what I'm telling you. The hardest thing to me in all of trading when it comes to options is not picking the trade. That's easy. The hardest thing ever is figuring out how to exit and how to roll. Rolling is an art. Exiting is not an art. It's a science. It's a simple science. So for me, when I'm looking at exiting an option trade, when I start to get down to that 50% loss, I tend to exit at least one. If I am on a 2-lot, I'm taking out one. Why? Because it's better to get the dollar back. I'm going to get $1 back in my account. I can roll that to another trade and make it back. If I don't, and it goes completely against me and I risk $1.70, okay, I basically give up $1 that I could have used. For me, I like salvage value. That's what people always ask. Why do you sell premium? Because I like salvage value. I like knowing that time is on my side. You burn theta decay. If it goes nowhere, I'm still being paid for it. But if it works against me, I can still pull salvage value out of this. That's why I do this. And I can tell you, I've taken hundreds of losses in my career, gotten the money back in and go, I'm just going to roll it back and take it. That's what I do. So for me, like I was sitting here at one point and I'm still short Walmart. I'm still short. I started short in the stock right here at that 127 level. I thought that was going to be done with. I was wrong. I was inside, pardon me, right over there. It rallies up here. So what did I do? I added another option. I added another option here. I rolled this one. Why did I roll this one? Because even though it rolled up against me about $6, $7, the premium didn't go up that much. On a percentage basis, I had a $5 wide that I sold for about $2.35. And to cover even up here was only to cover around $2.90. So I was down about $65. I'm like, no big deal. I was down, but I wasn't out. Now, if this had gone from $2.30 to $4, I would have eaten it. I'm done. I'm eating that loss. I don't care. But I was still in the game. I didn't reach that 50% threshold of a stop loss in the option. So if you're a person like me, and not every one of you do this, but I don't do anything naked. I never buy calls or buy puts ever. I do only premium, defined risk premium forever. And I do about 3 short premiums, 3 short call spreads per every one short put spread. I'm notorious call. So I got Walmart short right now. I got Coke working. I've got SYY working. I'm working all these shorts right now to offset. This one's working okay. I got up here. Okay. The reason why I didn't give on Walmart was because I didn't look at it dollar for dollar. I looked at it on a percentage basis. I contextualized it. So for me, I'm more of a person who leans to percentage loss than dollar for dollar loss. And for me, when it comes to an options trade, the dollar for dollar movement does not impact me nearly as much as the percentage movement, because that's really what it comes down to. Now this trade, and by the way, I rolled this and it expires a week from Friday. I'm sitting on a 120, 125 because I did it basically out of the money. It's coming back to me. Now, effectively, I'm ahead on the trade. I sold here, okay, doubled down and rolled this one. I normally don't roll. I don't, but I had enough time because I did 45 days, about 37 days, pardon me, 37 days. I had enough time to do the trade, enough time to make that trade, right? And the percentage loss wasn't that much. But if the time to roll the trade is too tight and I can't roll it for much of a credit or much of a debit, and I'm way behind percentage, there's just no point. There's absolutely no point in doing it whatsoever. For me, I can tell you this. It's better on an option. It's just better to get the salvage and get something out of it than to get nothing out of it altogether and wait on it. Kaufman tends to wait when he's behind. I don't. When I'm behind, I measure percentage loss. Again, my threshold is 50 to 60%. At that point, it's like, okay, if I'm a 2-lot or a 1-lot, I'm just out. I'm getting out of one, at least if one of the 2 lots or the full lot itself. I can take that money and go back into another trade and just put it right back on. I can just do it over and over again. That's what I'm doing. So that's just the way I approach it. We call it a percentage loss. If you're doing the stock or if you're doing a futures contract, it's a different animal. You have to evaluate on a notional value how much you're losing. This I look at as a notional value, but the notional value is defined risk, so it makes it that much more comfortable. It's what I call delta comfortable. Whereas if you're doing a stock or a future and you're unhedged, there's no delta comfortable there. You're wide open to get your ass kicked long and short. So if you're doing a percentage, this is my general rule is max 10, min 5. Usually I do 8 to 10. I can withstand the pain of 8 to 10%. I can do that. But if it goes beyond 10%, I'll usually start to scale out of it or take some of it out and eat it. That's what I normally do. But on an option, it's always on a percentage basis. Tomorrow, I will come in and we'll do it by moving average violation. It's an entirely different animal construct, quote unquote, mode. Yes, you can set stops by moving average. That way you avert the candlestick crap. You avert the getting triggered on a what could be a channel head fake. You avert like getting caught in the wrong integer or percentage loss. There's too many ways to do this to protect yourself. But the moving average works in both directions, both long and short. We will pick that up tomorrow. In the meantime, I've got a 1.5 hour mastermind today at 1 p.m. Whoa, I'm having a really good day. Whoa, I didn't realize it. A lot of my shorts are just absolutely blowing out the window. Oh my God. Yeah, I'm sorry. The longs, some of them are up. Some of them are like down fractionally, but the shorts are just right on. I told you, I'm not covering. There's no way I'm covering my shorts, people. Zero. Not going to happen. The only one I covered was Bank of Hawaii for one reason. Why did he cover Bank of Hawaii? Because my option that I sold up over here was worth a penny. When am I going to wait? I covered for a penny. It was 1 penny. That was it. There's no point in letting it go any further. It could go here. Don't care. What if Bank of Hawaii gets bought out? They'll jump up and I'll lose it all. Take the money and run. Don't worry about the commission. In the meantime, I'm just laying it out to the Genesis Cog members because everybody in Genesis Cog is short this. So they now know that
they bulldozers.
Brandon, we are down 40 points today. And you know what my attitude is? Well, down we go. I call it running up. I used Jackson Browne's album "Running on Empty" from 1977.
I saw your beginning. Yeah, I saw your
Brandon, are you going to fight me that this market is not running on empty?
Well, it's been running empty for a long time, right? So I mean, are we finally? And Don made a good point this morning. Is that have the retail investors in mutual funds, right? Their 401ks, have they liquidated their 401ks? No, right?
No.
But the marginal retail trader is pulling back right now, right?
Oh yeah.
And so all of a sudden the institutions we know are selling, insiders are selling. We just need to see that once the mutual funds, right? Once the 401ks start to go to cash a little bit, that's where we're going to see the real heavy selling. And that'll get us into a bear market territory.
Oh yeah. I see the rotations. They're selling all defensive. Anything, hygiene, cleaning, J&J, healthcare, drinks. They're selling them all.
Mhm.
This is a rotation, but they're still not selling Nvidia. And until Nvidia blows, we're not even close to a bottom. We're not even close.
Right.
Not even close. That's the way I
Right.
look at it.
That because again, those are the biggest representatives of every fund out there, right?
Yep.
So yeah, we got to see that.
All right, man. I'll let you go. By the way, people ask me, I got it. Somebody said, why is he wearing a turtleneck?
Cool.
Because it's 27 degrees outside and snowing. It's snowing outside right now in Chicago.
And you got the double neck. You got the turtleneck and the cowl. I love cowl neck sweaters.
I have to go pick up my kid from private school at 3, and then I got to rush her over. She gets her orange belt next weekend.
Nice.
She's got 8 stripes, and now she does roundhouse, she does hook, she does hammer kicks. She's awesome. Like my daughter at age 12, she's 5'2". My wife's 4'11". She's gonna be about 5'5". My daughter, no boy is ever gonna mess with my kid when she's done.
When is she gonna beat her? The question is, when is she gonna beat her dad?
What?
When is she gonna beat her dad?
Well, she uses me as a punching bag already. So, but I taught her how to defend herself because I have a black belt in Hapkido. When my kid gets to my level, I'm gonna be frightened of her because she's actually really fast with the like fists of fury. She's got quick jabs, really. So loving it. You're a dad, you know.
Yeah, I know. I have a nephew. He lives he's in Japan. He's my brother's son, and my sister-in-law is Japanese. He was into doing karate, and for a while, and like he was a pretty good puncher. He'd kick me. Like my brother's like, let him kick you. I'm like, do I want to let him do this? Let him hit you. I'm like, but he did a nice little leg sweep and got me on the soft tissue side by the fibula. Right. It hurt a little bit.
All right. I'll let you go, Browne. Have a great day.
Have a good one. We'll see you.